My name is Gary Dayton, and I'll be your host tonight. Thank you very much for registering and coming into Wyckoff in the Modern Markets, Part 2. Wyckoff is, just so near and dear to my heart. I've been studying the Wyckoff material for a long, long time, and it's nice for me, first of all, to be able to talk about it and present it to interested traders like you all. So welcome and thank you again for coming in. We'll just start here with the usual disclaimer that we need to do in the U.S. You know that there's a very high degree of risk in trading, so you want to trade with money you can afford to lose, or not trade with money you can't afford to lose. What we're going to talk about tonight is educational in nature. No trading recommendations are going to be made, and certainly I or my company can't be responsible for your trading results, and you are always encouraged to consult with a certified financial advisor or tax advisor before making any kind of investment or trading decisions. With that out of the way, we'll talk about what we're going to cover tonight, the agenda for this evening. It's Wyckoff's case study of the 1930-1931 New York Times average of 50 stocks, the second half of that. When I first read this case study, this is in his main course, I thought it was the most important material that I ever read. The fellow I mentored under had learned Wyckoff and really focused a lot. In fact, the two of us, we both focused a lot on this chapter in the Wyckoff course. And he had said that it had a profound impact on his trading, and I agree. It really has had a profound impact on my understanding of the market, my ability to read the charts, and of course my trading as well. So try to convey that to you tonight and show you how the principles that Wyckoff discovered back in the turn of the last century through the 1930s, just before he died, how they're still alive and well in today's markets. Everything from a weekly British pound chart down to a 5-minute S&P futures chart. So we'll talk about and see about, we'll see these principles being played across all different kinds of markets and time frames tonight. I'll show you also how I use it. I've kind of distilled it down into my own little way of using Wyckoff, and I'll show you that, and I'll show you the key principles that I follow, and then a couple of applications of that in my own personal trading, which is primarily the S&P E-mini futures, as well as equity markets, but I'll focus in on the S&Ps tonight. We'll talk about a classic trading setup, what's become known as fall through the ice, or a break to the downside of a trading range, and then a weak rally back up. I'll show you how that can set up and how you can trade that. And then we'll talk about resources for learning Wyckoff. There are lots of them out there. And I'll show you some of them, or I'll talk about some of them. So if you have questions as I go along, I can see you can type in the question box there, and I can see your question along with your name. So do that while we're talking. It's better than waiting to the end, because then it's out of context and we kind of forget what we've talked about. So it's always best to ask a question as we're going through the material. I'll see it here, and I'll pause and we'll address that question. Somebody's trying to call here. Turn it off. Sorry about that. Okay, so we'll start off here. We'll get going. So Wyckoff's case study came out of his course of instruction in stock market science and technique. It was originally published as a correspondence course, a weekly correspondence course, and he started to send that out in 1931. And this course is still published today. You can get it from the Stock Market Institute out in Phoenix, Arizona. As Wyckoff opened his case study, the very first thing he said, very first sentence he said is that the most important thing to know about the market is the trend. And since we aim to operate in harmony with the trend, a study of our daily trend chart, which is a vertical line chart with volume, is the starting point of all our deductions. And this is what he had as a trend chart, what he called his trend chart. And it is a vertical line chart of the New York Times average of 50 stocks. And that no longer, of course, is published, but it would be similar to the Dow 30 or the S&P 500 or maybe the NASDAQ 100. Note that he created his charts not by computers, they didn't have them in the 1930s, but by hand. Everything was drawn by hand, and so he had a very intimate knowledge of how the market moved. He was also a broker and would converse with other brokers on the street. He was very, very into his trading and into the market, lived and breathed it. And he would be talking around the Cracker Barrel with other brokers and be saying, well, you know, Livermore was buying Reading Rail today. And others would say, well, he may have been buying with you, but he sold it short in my office. And Wyckoff began to hear about this stuff and see these larger traders, the professional traders, in action, and then began to correlate those actions with what he saw in the price bars and in the volume. And that's why he's so unique, I think. I mean, there are a number of reasons why he's unique, but that's one of the main reasons. He also gave us a sequencing of events. We'll talk about that sequencing tonight a little bit to the downside. But I think it's really interesting to see that he didn't have fancy computers, didn't have lots of algorithms, didn't have, you know, real sophisticated indicators, just price bars and volume. And you'll notice on this chart that there are little S's here. Those are markets were opened on Saturdays, most Saturdays throughout the year, and they would trade for half a day. And so he would actually double the volume on the Saturday, and he wanted us to know that, so he would note that with an S. I've taken the data from the 1930-31 market. Somebody actually worked with this with a magnifying glass and put it into an Excel file, painstakingly recorded each of the high, low, close, and volume figures, put it into an Excel file, and then I brought it into Metastock. And so we will be talking about this section, not all of it, but I'm going to talk about some of the highlights here of the downtrend. This was actually the downtrend that led into the Great Depression. What in part one of this, Wyckoff and the Modern Markets Part 1, we talked about this rally here, actually a bear market rally, but a nice little rally, a tradable rally at the time. And so Wyckoff gave us a lot of information about an uptrend in that. And now we're going to talk about the downtrend here, the bear market side of the market. And so we'll start off with a buying climax, which is the end of actually covered this in part one, but this is the end of part one, and I think it's important to just review it here. And so what I'm going to do is take parts of Wyckoff's case study and section by section and talk about it, just as I did in part one. And then we'll look at how that applies, how those principles continue to apply today in more current charts. So we'll start with a buying climax. And just as a quick refresher, or for those of you who are unfamiliar with what a buying climax is, it comes in at the end of a trend, and it's climactic. It's the trend reaches its peak at this in a buying climax. And we can see the clues of a buying climax by a number of things. First of all, price begins to get quite overbought. If we were to put a trend channel on here, we would see that price has gotten up above the upper end of the trend channel where we would expect supply to come in. So we have an overbought condition here. We would also see, and I'm going to erase this so that we can see things clearly, we would also see the stride or the angle of ascent begin to steepen. The slope of the ascent begins to almost become what we would say today parabolic and unsustainable. And one way to identify that, we'll see more examples of this as we go on tonight, but one way to identify that is that price begins to get pretty far away from the trend line here. The main trend line on this leg is highlighted in blue, and you can see that price is getting pretty far away from it, and that's highlighted by the red line. So those are some basic clues. The larger clues, though, are that price begins to increase in its range, which is the difference between the high and the low of a bar, of a price bar. That's supposed to be a close there. So the range of a price bar, if this was the price bar here, sorry, I don't have great control over this mouse as I'm drawing, but if this is a price bar, this would be the high, and this would be the low price of that bar. If this was a daily bar, well, the low would be here, and the high would be up here, and we would say that this is the range of that bar, or the spread. Another term we use is spread. So we'll see the ranges or the spreads begin to increase. And here we have some gapping going on. So one trick that we can do is we can extend with an imaginary line, kind of use an ATR function, an average true range function, and begin to see that these price bars really are moving with some wider range and spread. And then volume comes in. The largest volume often, not always, but often the largest volume that we'll see since the uptrend began will come in on the buying climax. And the buying climax is significant because it marks the end of the uptrend. But let's take a little closer look here on this. On bar one, the very top of the rally here, we see the very highest volume, and yet the close is in the middle of that bar. It's in the middle of the range, kind of a poor close. What it suggests is that supply is coming in, selling is coming in. Another way to think about this is that if it were all buying on that volume, then we should see that bar close on its very highs, and it should move even higher than that. But as we go higher with volume, we should see a nice response in that price. But here we don't. We see the close come in on the middle. Then on bars 2 and bars 3, there was an attempt at an intraday rally, during the course of the day, they tried to bring the market up, but failed. Buyers couldn't sustain higher prices. Instead, sellers came in, and we know that by the way in which the bar closes. It's closing closer to the lows, certainly below the middle and just off the lows. So the intraday rally attempts fail, and they fail on high volume. Notice that this volume is quite high here, okay? So we're seeing selling coming in at the top of an uptrend by the high sustained volume and the lack of upside progress. All this volume, if it were buying, should show us more movement to the upside. But instead, it's showing bars closing closer to their lows. And Wyckoff would actually begin to take shorts here. He'd have a list of stocks that were acting weaker than the market, and he would be looking to begin to take, maybe not full positions, but begin to take short positions in the weaker stocks in anticipation of a decline from these highs. Okay? And again, if you have any questions on this, go ahead and just type them in. So how would you differentiate, Mark has a good question here, how would you differentiate the high volume bars with the widespread price bars around February 11th and 12th dates, which are these bars right here? And notice that there is high volume. Okay, excellent question. And this is supply causing this. And as we'll see as we get on to this, we wouldn't know it at the time, and we wouldn't be able really to know it now, but in a little bit we'll see a little more of this chart, and we can then make better deductions about what's going on here, and we can say that preliminary supply has come in, but we wouldn't know that right now. What's the key differential here? The key differential are on the bars that follow here. I'm going to erase this so we're nice and clear. On bars 2 and 3, we get down bars here, right? Closing down, and the volume is sustained. Look at what happens here. We certainly get the high volume here, but as soon as we start to pull back, look at what happens to the volume. It recedes very nicely, okay? That's the main difference, Mark, and it's a good question because we often see that. Gert says the high volume would suggest demand. Yes, it does suggest demand, both here and here, Gert. Absolutely. There's lots of demand coming in here, but there's also some supply. And how do we know that? Because of the way in which the bars are closing. If it were all demand, then we would see closes on the highs up here. But we don't see that. What we're seeing is closes in the middle. Closes in the middle and then closes down below on the lows. And only supply does that. Okay? When Wyckoff looked at the market and understood what was going on, he said that the market works by supply and demand and really nothing else. Supply meaning selling and demand meaning buying. And it's a constant tug of war every day in the markets. And we mark the close. It's one of the reasons why we don't really use candlesticks, or we don't even care about the open all that much. What we're most concerned about is the activity that occurred during the day, and that's the spread or the range of the bar. And we can see that, for example, on this bar here, fairly narrow range, closing in the middle, not a lot of activity there. As it came down, activity tended to dry up, and we can also see that in the volume. On bars like this, much wider range, much wider spread, higher volume, and usually there's a good correlation between the spread and the volume. Not always, but most of the time, because both represent activity. Here we're seeing lots of both buying and selling coming into the market. So good question there. Now there was another couple of questions. Let's see. How does this grouping differ from the grouping just previous to it? Mary, I'm sorry, I probably just kind of talked a little too fast there. Which grouping are we, if you can clarify which grouping you're talking about, I'll try to answer that. And Scott says, so that taking of shorts would be considered a very aggressive trade. I think so, yeah. I wouldn't, he would buy, he was in the markets all the time, and he would be seeing this intraday. On the selling climax, which occurred down here, he was looking to be buying intraday those stocks that he had selected out as stronger than the market. He would be beginning to buy them here. I'll just go through this with you. He'll buy them on the climactic action. He'll buy them on the testing that occurs, and then he'll buy more on the breakout. Those were his three locations in order of preference. He liked the climax if he could identify it because it was closest to the danger point. He could set his stop very close to where he was buying in. The next best spot would be on the secondary test, what he called secondary test. We just call it test today. In here, because again, we're not too far away from the danger point, being just underneath the climax. And then here would be his third or his least favorite location to buy, because we're far away from the danger point now. But still one that he would do. He would buy on breakouts frequently. So here we would be selling into climactic action and setting stops just above the highs here, and so we'd be close to the danger point. So it's from a risk perspective, if you can identify this. And let me back up and say a word or two on getting good at this. It takes time and it takes practice. This isn't easy to learn, and it can be, when you're trying to do this real time, we're doing this, in hindsight and with static charts. When charts are dynamic and live, and we're trying to identify what's going on, it's clearly a lot harder. You start putting money behind it, and the psychology changes, and the emotions begin to come in to play, and the stress of all of that begins to narrow our focus and our ability to reason and to think well. And so you need a lot of practice in this to get good at it, to get to the point where you can really trade it. So if this is the first time you're hearing it, or if you're still categorizing yourself as more or less as a novice, work with this. Study your charts a lot before you start trading it, because being able to identify climactic action in real time is not necessarily the easiest thing in the world. It's not impossible either, I should say that, but for novices, people just starting out, it's not particularly easy to do. There are other spots where you can look, and we'll see where those other spots are that are probably a little easier to read than trying to identify climactic action when there's all this frenetic activity going on. But he would start to take shorts in anticipation of some sort of a decline. Kind of aggressive, but I don't know that he would think of it as aggressive, because the risk would be least at that point if he could see it correctly. Okay, Mary, I did respond to your question. Good, thanks for letting me know that. Okay, good questions. Oh, I like those. That helps too, to break this up a little bit. All right, so let's go on a little bit more in this chart, and let's highlight some of what we've started to talk about here. And this is the same chart, just spread out a little bit, and we've got a few more bars on here. We stopped, I think, at bar number 3 or 4. Look at bar number 6, okay? And what we notice about that is that it's the largest range bar from high to low, the largest spread since the uptrend began. And when Wyckoff talked about this, he said that this bar on sustained volume, and we'll talk a little bit more about what that means. I want you to be very clear about this. because it's a key concept. But this widespread bar down is on sustained volume is a complete change of behavior to what we have seen before. And he said that it broke the backbone of the uptrend, this particular bar here being the widest spread or range bar with the largest volume to the downside since the uptrend began. Okay. So volume remains high. It's a key consideration from bar 1 down to bar 6. You can probably see that. Okay. And I identified here, I marked earlier reactions as A's here in the down bars there. And look at the volume that comes in down here. Notice, and as we said before in addressing Mark's question, he said, well, how do we know that this is not climactic? And one of the reasons we know is that on the very next bar here, volume starts to dry up. Here, it doesn't dry up. It's sustained. And in fact, on bar 3, we get an increase in volume. And then we're driving down. And if you look back here, we don't see any big down bars like this, do we? We do see one that's comparable, but not quite as large down here, right at the very beginning of this. But there's a lot of, this is climactic action, and that's, you know, that's not unexpected to see some volatility down here. But now volatility is coming into the downside on sustained action. And this is what we call a change in behavior from what had been going on previously. When we reacted, volume dries up. And I want you really to see this clearly, okay? So what I've done here is I've highlighted all of those reactions earlier with bars here, green bars, okay? So coming into the secondary test, volume dries up compared to the down move here. We rally up, some volume comes in. As we come down, look at how low that volume is. As we come down here, volume is low. We rally up, we get that big pop up in volume, but as we come down, volume is relatively low. But look at this. Yes, it does recede, it does diminish bar by bar, but relatively speaking, compared to all the prior reactions, this is a change in behavior. Everybody see that okay? Can you see this clearly? Let me know if you have any questions about this. Because I'm trying to make the volume stand out here, and this is the best way that I know how to do it without manipulating the data. And I'm going to kind of hammer this idea home. It's one of the classic things in Wyckoff that we can come away with is to study when we're looking at market structure, higher highs and higher lows, just to put simple structure together, all the way up in an uptrend here. As we're looking at these higher highs and higher lows, we don't want to just look at higher highs and higher lows. We want to look at how it's doing this, so to speak. You know, what the progress it's making on the way up, and also how it's making that progress. So as it's coming down, when we're looking at structure here, as we're looking at the down waves or the down legs, the reactions versus the rallies, we really want to, you know, sometimes I draw boxes on my charts, and it can be helpful to do. Okay? All right, good. All right, let's look at, here's an interesting chart. I like this one a lot. This looks really ominous here, but I'm going to back us off in a minute with a little bit larger, but I wanted to highlight this. This is IWM. It's the ETF, and it represents the Russell 2000, the smaller cap shares in the U.S. And look at this down wave here. Look at this reaction, and look at the volume. My gosh, I mean, there's nothing that comes close to the highs here, and certainly nothing that comes close to this whole amount of volume in here. No other reaction does. We get some volume coming in here on this reaction, but it pales in comparison. It's maybe And if I look at maybe the average in there coming in here, it's probably half of the range in here, right? Although this was kind of suggesting that we were going to see some downside, this really sings it in a loud. And this is occurring, by the way, in July. I don't know if you can see these numbers here, but this is a weekly chart, and this is coming in towards the. Oh, I'm sorry, this is a daily chart, and it's coming in at the end of July. Typically, in the United States, a lower volume period. It's summertime for us, and a lot of folks are on vacation. We don't have a lot of volume in the markets during the summer months. And I remember watching this. We were looking at this and saying, my gosh, what is going on with all of this volume coming in? So let's step back a little bit and just take a look at this. Again, now I've gone to the weekly chart. I got myself confused, which is not so uncommon. So we see the largest volume on the chart here, no question, on a weekly chart. And it just is suggesting to us that supply has come into the market. The rally back up has nowhere near the same kind of volume. It doesn't match that volume at all. And it's the start of the 2007, 2008, and into the first quarter of 2009 bear market. So we see, a large range down bar here that's breaking the back of this rally up. We don't see any. Let me just highlight this. It's the first bar here. It's a little difficult to see, but we don't see any other week on this chart with that kind of spread to the downside, and certainly with that kind of volume to the downside. And so we see a change in behavior here and a breaking of the backbone of the advance. Okay? And it suggests that the market is no longer being supported. There's no bids underneath that market. It just almost free falls. In 1 week, it wipes out, weeks and weeks worth of buying that occurred here. And then we have this dramatic bear market over the course of the next year and plus. Okay. Any questions on that before we move on on the IWM chart? You can go back and look at tops in the markets and see this for yourself. This is my interpretation of Wyckoff. Don't just believe me. Go back and really look at it for yourselves. And in doing that, you'll begin to ingrain it in your mind. You'll be able to see it when it's happening. When we think about the current market, we don't see anything like this, right? The flash crash in May had the potential to do that, but it held the lows there and has continued to go higher and dried up whatever supply existed at that point. But and it didn't really break the backbone. It looked pretty dramatic, but it wasn't on a larger time frame. It wasn't as dramatic as this kind of a move. But you can be looking for these. And if you're not, a lot of folks, even day traders, are looking at hourly and maybe daily charts. Don't short circuit the weekly and even the monthly charts. They're all important. They're all helpful. Question, people thinking that they were getting a deal. Yeah, they were buying down here. Well, you can see the buying coming in down here. No question about it. And it's not a surprise because we were in quite a nice trending market really since the lows of 2002, and we're up 5 years now, or 3 years, 5 years later. And markets don't change on a dime, even on a 5-minute chart. It's rare to see a spike one way or the other. You see actually spikes on the lows more frequently than you will on the tops. So we will almost, you can almost bank on some kind of a rally back up, and you can bank on some kind of buying coming in. And there was good, strong buying coming in there. But as the market rallied up, it got weaker and weaker. But yeah, they thought they were getting a deal. Buy on the low, buy all the pullbacks. Okay. But those of us who were smarter than what we thought we were smarter were selling, and then it rallies up. But that's okay. Yeah, so the high, Scott asks, is the very volume at the end of the red box, is that some buying? Yeah, definitely there was some buying coming in. But there was awful lot of supply in there too, as well, the last couple of bars here. And we know that it's buying because it's closing on the highs. And there's also a little shortening of the thrust coming in here to play. And only buying does that. I'll talk more about shortening of the thrust a little bit later. It's an important Wyckoff principle. But that being said, you can see that they had a really tough time holding the lows here. It kept slipping and slipping and slipping lower. And it spent a month down below this last support level over here. So it was pretty significant overall. Yeah, the backbone, the breaking of the backbone is right here, Tony, is that big widespread down bar. And, you know, the backbone is just, you would have a trend line coming up here. You can think about it that way, a trend channel. And, you know, there's other things to think about up here. It's not coming all the way up to the supply line. The top of the trend channel would be where supply comes in. The bottom of the trend channel is where demand is coming in, called the demand line. So demand comes in here and in here. Supply was coming in here. We would expect this market to come up here and see supply come in at this point, but it can't even make it up there. It starts to round over. And here we break the backbone, and then we are rounding over this kind of mushroom top, and then it comes off from there. Good question, though. All right. Let's go back to the 1930-31 market here. We're back into March of 1931. And we left where we left off was on bar number 1 here. And Wyckoff talks about this area in here. Well, he calls it secondary distribution. For those of you, I often get a lot of questions about accumulation and distribution. Well, here you'll get a nice introduction, I guess, to distribution. The initial distribution comes in here. SMI later calls this kind of thing preliminary supply. Climactic action, more distribution here. The primary distribution is taking place over here, and then Wyckoff would consider this to be secondary distribution. I think today we would just call it all distribution, meaning that the market is held in a trading range, allowing selling to take place. Wyckoff was keenly interested in the largest operators of his day, people like Harriman and Gould and Morgan and Livermore, the professional operators. And he saw that the market was manipulated. How manipulated it is today, I'm sure it still goes on, but I try not to think in those terms. I just try to think in terms of who's really in control here. Is it more the buyers are in control, or is it the sellers who are in control? And up to this point where we left off in the market, we've had a change in behavior, so it suggests that sellers are now coming into control in this market. All the way up, the buyers had been in control, and they've driven prices higher through their demand or their buying. Okay, so we come down and we've come underneath this level of support over here, and we get 4 or 5 days of sideways action here, okay? And because we've come down, let me back up a second. We've come down 5 or 6 days here, 1, 2, 3, 4, 5 days of progressive lower lows, and from the top it's 7 days here of progressive lower prices. So market gets oversold after that number of days. We don't usually see much more than 3 or 4 days, sometimes 5 days in a row. We had an example a few months ago where the NASDAQ had put in 11 straight days to the upside. I went back, that was in 2010. It was 10 years ago earlier, in 1990, when that last occurred. So it doesn't occur all that often. And when we start to see 5, 6 days in a row, all going, trading from high to low, high to low, high to low, and closing poorly, it gets oversold, okay? And when we come into a support level, we would expect some buying to come in if we're coming into the downside. So we get a little buying coming in on bar number 2 and bar number 4. We get 3 or 4 days here of sideways action. And the higher bottoms here, the higher lows, Wyckoff called the low of the bar bottoms. The higher bottoms and this kind of firm close on bar number 4 is suggesting that we've gone from a technical condition of selling to a minor bit of strength here, and that we can expect to see a little bit of upside because volume is still pretty sustained in here, and we haven't gone down, and we're holding higher bottoms or higher lows. So buyers are holding this level at this point. But given the negative background that we have here, all this supply and this change of behavior, it's unlikely that this is going to turn the market. But we have to wait and see if we were looking at this on the live edge of the chart. Now, Wyckoff used to use the halfway point. He would take, let me erase this so you can see it clearly. He would take the high and the low of a swing, and then he'd cut it in the middle, which was about right here. And he would basically say that markets have a right to react halfway, and that would be an average kind of reaction, which makes some sense, right? So our rally here to bar number 6 is just above the halfway point, meaning, and then it comes down from there, meaning that buyers are unable to bring it up to make new highs. They could only get it up to an average rally. One thing that's significant. Another thing that's significant about this is that notice where bar number 6 comes to, right into the breaking of the backbone bar here, right into this high supply area. We would expect, where the market accelerates down like this and shows large supply coming in, we would expect any rally coming up into that to die off there, because sellers would come back in. They know this it exists here as well, and they would come in and sell more. They'd probably think it's kind of a minor holiday for them. They have an opportunity to sell more stock short at this point. Pat says that he or she's got to leave. I'm not sure which you are, Pat, and I don't mean to offend you, but I want to cover both bases. And yeah, it will be recorded, and it should be up very shortly after this, so you'll get a chance to review it. And we're going to leave this recording up for a while, at least 6 months, and maybe longer. We're trying to work out with our internet service provider some additional space. But you'll be able to review it at least for the next 6 months. Okay, so the rally to 6 is just above the halfway point, and it's just coming into that supply area where we would expect supply to come in, okay? And notice also that, and I boxed this in, the volume on this rally here is not close to the rally up here or the last two swings up. We're not seeing the same level of volume coming in. And also notice the ranges or the spreads. They're fairly narrow compared to what we see here. And also something David Weiss calls ease of movement. We see more ease of movement coming down, more impulse or momentum to the downside and we see a labored kind of irregular rally going up. Here we see ease of movement up, ease of movement up. Here, no ease of movement up. It's just kind of choppy going up, okay? So what we're looking at then is a market coming into a level of existing supply about halfway, an average rally, a rally that has volume that's not in keeping with the rallies that preceded it, and both the spread and the kind of action is not in keeping with what had preceded it. So for all of those reasons, we can see this at bar 6 here. We can see that there's no buyers coming in here. There's just no buying coming in. And on bar number 6, we get a little pop in volume, and it closes poorly. If you see here, it's closing not only under the high of the previous bar, but under the close as well. So it's wiping out the buying that occurred there, and it's coming in on a little increase in volume. So it kind of signifies that there's a, not kind of, it signifies that there's a minor climax here, a minor buying climax on a little pop in volume and a poor close. Then look at how we have, it's easy again to move this market down. And again on sustained volume. We're not coming into low volume like we saw on the previous reactions. The volume is still pretty sustained, and it's coming down quickly. You know, compared to this, which just stands, or just goes sideways, or even this, which comes down, but not, there's no ease of movement coming down here, okay? Everybody see that okay? Let me just know whys or yeses. Let me just make sure you're following this here. I don't want to leave anybody behind. Good, okay. And then we have another rally up to bar 14 here. And again, it's an irregular rally. There's no ease of movement. It's a nice term that David Weiss came up with, ease of movement, or no impulse to the upside. And it can't even get up to bar number 6. It's again in that halfway area. Here we get a clear pop in volume, a sudden increase in volume. The close is midway. And then the next 2 bars, there's just no ability to go higher. If all of that were buying, we wouldn't see this. We would see bar 14 be closing on its high, and we would expect to see the next couple of bars go up from there. But we don't see that. They just go sideways. So that signifies that bar 14 also was a little minor climax to the upside. Notice here on bar 19, it tries one more time. And now look at the volume here on 19 and compare that with 14 and bar 6. When we get up into this area, there was still, you know, as we look at the volumes here, certainly there's supply coming in. We know that by the close on the bars, but there's also some buying coming in as well. But by the time we get to 19, there's just no more, there's no more buyers left. And we see that not just only in the bar and the way it closes poorly, but also in the volume here. And we can see that there is a tapering of volume as we go through this little trading range. So one of the ways that I look at this is that, gee, buyers had a chance to bring it higher here and fail. They have another chance on bar 14 to bring it higher, and they fail there. And one more time, they have a chance on bar 19, and it's really anemic at that point. So 3 strikes and you're out here, the old baseball. And now we come down, and we start to come down. And notice as we come down on bar 21, notice that the volume increases as we approach a support level formed at 1 and 9 here, right? Now, this is not climactic. Why? Because it's not occurring really at the end of a trend, even a minor trend, and it's coming in and it's approaching our support. And when we see wide spreads, poor closes like this, and an increase in volume as we approach the support level, then the odds favor that that support is going to be broken. It's an important Wyckoff principle. I don't know that anybody else ever talked about this besides Wyckoff. Maybe somebody else has, but I'm not aware of that, that they have. Wyckoff definitely talked about this several times in his courses, and it's an important concept. It's one of the things to, if you short up in here, and you say you short at 6 and you're coming down and you don't see that increase in volume here at 9, then you got to make a decision. Do I exit out here at support, or do I hold through and maybe tighten up stops and just be prepared for some kind of a rally back up? But here on bar 21, we see volume increasing. We can feel pretty good that the odds are in our favor that now this thing is going to break to the downside. Okay? So just to summarize here, result versus effort. Mark, I'm not sure, are you talking about bar 21, the effort to come down and the result being to crack the support? I would agree with that, yeah. Result, by the way, in Wyckoff terms, refers to price movement, and the effort generally refers to the volume. It's kind of like the volume is the fuel and the price movement is the result. So here, for example, just to highlight that, good, Mark, I'm glad you brought that up. Here on, say, bar 14, we see good increase in volume, but the result is we don't even put in a new high here, and the result is fairly poor. So the effort is strong, but we don't get any satisfaction in the price movement from that effort. But on bar 21, we see pretty good effort coming down, and the result is that we crack open the support level, and so we're getting satisfied here. We're getting good results for our effort. Gert says, what was the status of the short selling rule then? Oh, Gert, I have no idea. That was way before my time. I don't know what they did for short selling. If they just allowed it to happen at then. If anybody knows, type it in. I'm not familiar with the short selling rules, whether you had to have an uptick or not. I don't think that came into play until after the 29 crash and the Great Depression. It may have been in play here, but I don't think it was. Anyway, okay, let me summarize here and then we'll move on. We see some initial, now we can say, by the way, we couldn't say it at the time, we just couldn't see it, but now we see a line across here, don't we? If we were doing a point and figure chart, we would see a large, what we would call a cause, a large amount of selling because price was kept in a range here. But we see now at the end over here, we can now look back towards the left, and we can make a deduction that there was supply that came in here, okay? There was inability to hold gains on very, very high volume up here. So there's supply here as well, okay? The market falls on sustained volume compared to any other reaction. This is markedly higher. That also is supply. The market makes an average rally back up to about the halfway point, comes into where we know where known supply exists, and it falls from there. That's another indication of supply. It's easier to come down than it is to rally this market, right? That's another indication of supply. we make an irregular recovery here. We have 3 times where buyers have a chance and they can't put it together. So we have more supply here. Okay? What I'm doing is I'm putting together the background here. I'm looking at the structural characteristics of this market from a demand and supply point of view, and I'm putting together a story of ample supply in this market, lots and lots of supply in this market, and a total lack on the part of buyers to be able to move that market. So as this market in here is okay to add other shorts, Wyckoff would say, as this market is breaking down is another opportunity to add shorts as well. Safer probably in that we can see what's going on and we can put together that story of supply here better than we could up here. But from a risk-reward perspective, we would probably, if we took shorts in these areas here, we would still have to place our stops higher up. And so from a risk-reward perspective, not quite as good as the climactic level here. And then the decline begins, doesn't it? And we can see here right at the end, we try to rally up, and look at how anemic this rally is and how low the volume is here. Okay? All right. Any questions on this chart? Very important chart if you want to understand distribution. And, you know, I encourage everybody to get a hold of Wyckoff's. Oh, Ray says he lost sound. Anybody else lose sound here, or can you hear me? Okay, it's back on. All right. Anybody else lose sound? Ron says it's okay. Mark says, okay. All right, good. Okay. Sorry, Ray, we don't want to lose you, that's for sure. I know you're out there in the Far East, and we certainly don't want to lose you. Okay. Yeah, please explain the high volume on bar 22. It's just more supply coming down. We do certainly see some buying. Some folks may have thought that there was opportunity here on 22, and so we see a narrower range, although I would extend that, at least in my mind's eye, and it would be a fairly wide range, not quite as narrow, because you do have a gap down, and I would extend it in terms of thinking in terms of average true range. The average true range is either the distance from the high to the low, or in the event of a gap, from the last close. Okay, and so we would extend that down a little bit, and so it doesn't look quite as unusual that way if we do that. It's a little bit of a trick, but basically what it is people are bailing out here. Some buying going on for sure because of the high volume, but mainly it's supply coming into the market. All right, let's take a look at ABT. I think this was last year, just to show you that this stuff really is alive and well. This is an American stock on the New York Stock Exchange, and we see here on bar 1 and the bar before, we're not making good progress up, but we're closing in the middle. We don't really have climactic action here. But notice bar 2. We see that large range bar coming down, closing poorly, and we see an increase in volume. Bar 3 comes down, and we see sustained volume on bar 3. And we come all the way down, okay? And then we look, and we see we get a rally up, not even to the halfway point. We don't get that until bar over here, bar 35. But again, this rally here is quite anemic. We're not seeing any kind of good movement, no ease of movement up the way we are in prior rallies. It just goes sideways for days and days and days. And as we come up to the top here on bar 35, notice we get a little pop in volume and a poor close. The next bar tries to rally up, does so on less volume, And then look at the bar that follows here. We get a down bar and a big increase in volume. And I just labeled that with an S as supply coming into the market. Okay. So we see inability to hold the high, a good immediate sell-off, wiping out about a week or so of buying that occurred. We break under the support level here. We really, well actually, this is what I would be considering as support here. This would be the first line of support. I'd want to see this market come to here and then rally off. Notice that back here, that's what it does. And this is typical. We see that stair-stepping kind of movement in a market where we rally up and we come back down around the same zone area as the last high and then rally up from there. We don't. We come right down through that and we make, you know, if this is our last low down here, we make a lower low and another lower low here. We make some higher highs here, but they're weak, and then we start coming down. So again, it's that kind of, you know, 3 strikes and you're out idea here. We try to rally up 1, 2, and 3 times. We can put a diagonal line across here and see that it's holding within that little trading, that trend channel or that trend line. We see supply coming in. Not surprising that it's coming in at this level. Why? Because if we look over to the left, we see that is where we saw bigger supply come in earlier. So as we come back up into that supply level, we would expect to see some shorting going on, and that's exactly what happens. And then it comes down, and each time it moves down, volume increases. We'll look at that, and then it gets climactic down here. So that's a stock from not too long ago. Here's the British pound on an intraday chart, a 180-minute chart. Again, we see that, and here's kind of a clue to all of this too. We see that long sideways line, several days worth, where buyers try to come in and bring the market up, but they get held at this level. And if we go back here, we can see that there was some supply that came in over here. It rallied up, came down, tested that, came back down, tried to hold here, but came underneath. And then this serves as an important resistance level, and we can see that here. We can also see, not only is this a long line, sideways line here, allowing cause to build up, allowing sellers to go short at favorable prices. Favorable prices are these higher prices, these locally high prices in here. But flipping that around, buyers again have opportunity to rally this higher and just can't do it. Several opportunities. And if we look closely, as we come down here and here and here, these are 1 3-hour bars here coming down, much quicker and swifter and easier to move this market down than it is to move it up. And that should be pretty clear. And then we break. And as we come down, you can see that the supply comes in here. So that's the British pound futures, not the FX market, but the currency future itself. We see distribution there. Now, as said, and we've seen now a couple of examples where we don't always get climactic action. We don't always see it at the top. Now, Wyckoff kept a list of stocks in various groups. He would keep, 5, 6, 7, maybe 10 stocks, if that many, probably more like 5 to 8 stocks per group. In his day, it was the rails, the chemicals, the food producers. Today, we have sector indices, like the financial sector. I have them listed here in this in this on this chart. Here's XLF, that represents that's in black here, that represents the financial sector. We have XLP, which I think is the consumer staples, that's in green. And then XLV is in the healthcare sector. Probably not as big a contributor to the overall market, which is represented by SPY, SPY. That's the ETF for the S&P 500, and that's here in blue. But what Wyckoff would do is he would assess groups, the group strength for comparative strength and weakness. And he would identify the weaker group, and then he'd identify the weaker stocks within that group, and those would be his sell short candidates. If he saw the market was rallying or about to rally, he would assess his groups for strength, pick out the top 2 or 3 groups that had the strongest, and we'll talk about what strength is and weakness is in a minute, and then he'd select stocks from there. So the basic idea here is that most of the groups should be moving in tandem. In other words, they should all be making their highs and their lows at about the same time. It's when they start to decouple that it can signal a change in behavior and potentially a change in trend. Okay? So here we can illustrate this at A. This is before the flash crash in May. You can see that SPY makes a new high up here. The financial services ETF, XLF, does not make a new high. It makes a lower high up here. SPY is making a higher high. We see that XLP is basically about even, maybe a little lower here. And the healthcare sector has already started to turn well before the market. And you'll see this in stocks. And notice, too, that when the market falls, the weakest market here goes the lowest underneath its last low, okay, compared to everybody else. And this is down here somewhere because I couldn't fit it all on one, and same thing here. So that's a way, if you have never seen this before, that's a way to identify turns in the market as well. And if we don't see too many climactic examples in the indices these days, but we still see them in individual stocks for sure. But I like to use this comparative weakness, comparative strength quite a bit. And Gert says ABT is at a low yesterday. Yeah, yeah, I think that's right. It's been gone down. Oh, Ray, you're in Hong Kong. Yeah, I know. Okay, so that's comparative strength and weakness across sectors. Well, you can also do this, and this is something that I do every night. I look at this. I watch the 4 major markets in the U.S. The S&Ps, and here we're using, these are weekly examples on SPY. So that's the S&P 500. The market in orange is the diamonds. That's the ETF for the Dow 30 stocks, the Dow Jones Industrial Average. The red is the NASDAQ 100, represented by the QQ, the Qs. And then IWM, the Russell 2000, the small cap stocks here in the U.S. So look at how this works. It's really helpful if you've never seen this before. And I'll show you an example how you can trade off of this too a little bit later, how I do it on an intraday basis as well. We make lows at A here. And notice Russell makes a lower low. Everybody else, NAS is holding higher, Dow is higher, the S&Ps are slightly higher to about the same. Okay, so relative weakness is seen here, or comparative weakness. We rally up, and SPY comes up and makes a new high, a minor new high, but a new high nevertheless. The Dow the same, and these two are going to be paired pretty closely for the most part because there's a lot of stocks in the top 100 of SPY that are all in the Dow. So they're going to mimic each other pretty closely. Look at the Qs. The NAS 100, the tech stocks are rallying higher, but look at our friend the Russell. Continues to show relative weakness, right? Down at C, the Russell comes about even with A. Everybody else is holding higher here, right? But then we see that weak rally, and the Dow starts to fall and the S&P starts to fall. And even here over at E, we can see that the Qs make a little bit of a higher high. Russell all of a sudden has become, and you'll see this happen too, by the way, they'll shift back and forth. Russell finds some strength, but the Dow and the S&Ps don't have that, and it just portends a sell-off here. So that's comparative strength and weakness. You can do it on individual stocks, you can do it sectors, and I like to do it especially with the major markets. And it comes out of Wyckoff. So let's look a little bit more on weakness. As we say, there's many times when we won't see climactic action. We just went through comparative strength and weakness as another alternative to help us assess that. Yet, even if we don't see climactic action, weakness is going to be seen. Now, we're looking at the S&P E-mini market here on a 5-minute basis. And we have no real climax. But as we come down here on B and on C, look at what happens. We start to see an increase in volume, don't we? And then we have So we have a little bit of supply coming in, but we want to have some confirmation before we start taking trades here. And we look on the rally up to D and look at how the volume just doesn't come in on that rally. And again, it's about the halfway point, right, into here. And notice it gets stopped right where we see a known level of supply from B, where B came in, and we see that widespread down and the potential backbone breaking of this rally up. And just like we saw in 1931, here's a 5-minute chart of, probably a few weeks ago, and it's the same principles. Over and over. And by the time we get over to E, it's just that irregular anemic rally here. Yeah, and Mark says it looks choppy on its rally up to D. There's no ease of movement. Exactly. And let's be clear on that. Good observation, Mark. We have nice ease of movement coming up here, don't we? We have ease of movement now to the downside, and we've got chop coming in here. Good observation. Very good observation. And here's the result of that. And we ended on E, the last chart, but look at F. As we come down and approach support, we see the widespread poor close, and what do we see? The high volume come in to the downside, right? It tells us in advance the odds are really good. Not 100%. Nothing is 100% in this business. But we know that the odds are pretty good that this thing is going to likely break here. It tries to rally up. It does so on lighter volume than it did coming down, but still some volume. You'd have to be wondering, is this going to rally? But the very next bar shows that it can't do it. It's hugging lows in here. It's just hanging right near this support line. And then it finally breaks and comes down. So you can use this stuff on the 5-minute S&Ps, and we see as it comes down, we see volume increasing. So you can look for If you didn't take a short up in this area in here, you can look for a weak rally back up, into this area somewhere to short and potentially come back down and test the low of the day. All right. We'll go back now to the 1930-31 market. So here, as the market comes down, I want to really spend most of the time talking about this little section in here. And as we come down, we're coming into this support level over here, where this was absorption earlier on, just going sideways. So we come down here, and we would expect, when we come to a support level, we would expect some kind of pause at minimum, and preferably a rally to take place. And we go 5 or 6 days here of sideways action, and we don't have any kind of rally up. Also, we don't have any kind of evidence. We have no evidence of climactic action here, and just no ability to rally. Okay, we're just coming down, and then we go sideways here. There's no potential to rally at all. Excuse me. Now, it's a little tough to see here, so I made an inset of this area. And the bar I'm marking here with my blue arrow is the same bar marked with this red arrow over here. The market comes into dead center, and Wyckoff was very acutely aware of when the market came into an equilibrium point, and he called them hinges or apexes. We would maybe call them triangles today. The point being, or the idea being, that the movement of price comes down to a point and it's dead center or close to being dead center in that trading range. And so if the market is going to move, at this point the market will move one way or the other. So if it's going to rally, it should rally, and rally fairly vigorously from here. And it does make the attempt to rally, but the second bar here, the first bar is pretty anemic, and the second bar just wipes out the buying that occurred there. And then we gap down the next bar, and we see that volume starts to come in. I highlighted it here too. Volume comes in to the downside. So these little apexes are nice points to be able to recognize in charts and to see them, because it's at that point that something is, the odds favor that something is going to happen soon, and it's going to either move up or move down from that center point. But as it does try to rally up, let me erase this and just talk about this here. As it does try to rally up here and here, it can't really enlist any buyers. There's not much volume coming behind this, and the spreads aren't very wide, and then we get that move right back into the dead center on this second bar right in here. And so it just says that there are no buyers here, and there's the reason for the gap down the next day and then sustained movement to the downside. And we get that persistent downside volume. Let's see, January 25th through the 9th. How can you tell that this sideways is different from the one between January 25th and February 9th? Okay, Barbara, good question. You're talking about this sideways movement in here, right? How come this is different? How come this is different than this? In a way, they're not much different, but in a way, they're very different. Okay, first of all, we have ease of movement coming up, impulse to the upside. Momentum is coming up here, right? we're making higher high, higher low, higher high, higher low. We come up into this area, and this is some supply that we know came into the market. And I've gone back and looked at his earlier charts. It doesn't show it in his course, but there is a supply area as well back in this area, further over into the chart. Okay, what this is called absorption. It's just going sideways, and as it dips down here and makes lows, and look at that volume here. That's that volume bar right there on February 2nd. As it dips down, it doesn't draw out volume to the downside. We also see a lifting of the bottoms, a lifting of supports, suggesting that buying is coming in here as we get closer and closer to the end of the trading range. Of course, we don't know when that's going to end, but we see that we're holding gains here. We've rallied up quite well, and now we're just going sideways, holding gains. And at the very end of the trading range, we start to see a little increase in volume, and the closes, especially this last bar, and the lows start to lift, and the close is on the high here. And it's right underneath this resistance level right in here, okay? That's what Wyckoff called absorption, and the result of all of that effort in here is to rally the market up. And it's a nice concept, and we see that all the time. Here we're going sideways too, but we have a totally different picture. The structure has changed. We went through all the supply idea here, but just in general, we have a lower low here, a lower high, a lower low, another lower high in here, right? Lower low, lower high, no ability to rally. We do try to come up here, but right at the top of this little sideways shelf here, we have just the opposite of what we see over here. Let me erase this so you can get a clear picture. Here we're closing on the high with a little increase in volume. Here we're closing on the low with an increase in volume. So structurally we're in a downtrend, lower highs, lower lows all the way, and we go sideways, meaning that there's no buying coming in. Here we're going higher, making higher highs, higher lows, holding at a known supply level and holding well and lifting up and absorbing through whatever residual supply exists there. So those are the main differences there. Good question, thanks. Does the weakness seen previously in the market favor a move to the downside out of the apex? Yeah, Scott, it does. And you'll read in more modern technical analysis books and journals that triangles tend to break to the side, tend to break with the trend. So if we've got a downtrend in place and we see a triangle occur, then the odds favor it continuing to the downside and the opposite for the upside. So yeah, you would expect it to break in the direction of the trend. The trend will go on much longer than most of us will expect. Okay, so let's take a look at this on a current market or a recent market in the S&Ps. This is a 10-minute chart of the E-minis. We have volume coming into the downside, wide spreads coming in, and so we know that there's supply in the market. We don't have to see anything else on this chart. We know that that's supply. We get a rally up, a little bit of demand comes in, no question, but notice that we come into that apex here. And in general, on this rally up, we're losing volume as we go through this. We come into the apex and it breaks to the downside. Again, we see widespread increase in volume as we come into the support level here that's formed underneath A. And so we know that the odds favor a break of that, and we break down to D. We come up here to E, and once again, volume just doesn't materialize. We have that little apex right in here. So if you're trading this, you can set a sell stop right underneath here, or you can just go short in here if you like. There's different ways to make the trades, and you know whatever it is you're most comfortable with is fine. But you see that it breaks. Again, we see an increase in volume, widespread. Even though we go sideways in here and try to rally, we don't really get very much. There's not a lot coming in, and then it comes down and closes for the day near its lows. This is a typical, well, maybe not quite typical, but a nice little trend day to the downside. We don't get a lot of these in the S&Ps, but here you see the Wyckoff principles. You know, just when you start to study this and you start to say, okay, how does this apply to the current markets, and how do I see it working here in the markets that I trade? And you begin to see that Wyckoff really understood his markets. He really understood how the stock market worked. And I just love the classic way of looking at the markets. I really do, because you can really see it. Okay, on a larger level, that was a 5-minute chart. Here we are, Goldman Sachs on a weekly, just to highlight. I'm going to start to speed up here because I'm realizing we're going to go half the night if I don't do that. But you can see I boxed it in, low volume here, low volume here. You know, begin to start to see this, and it will, this kind of stuff here will not be scaring you away, okay? You'll begin to be able to read it better. But it's the same thing. When you're assessing the structure, higher highs and higher lows, or lower lows, lower highs, be sure to assess the volume on the rallies and the reactions when you do that, okay? And again, not only for the bigger term structure, we're back now to a 5-minute S&P chart. Looking at tape reading on the intraday. You don't really need to get too complicated. You can just keep it simple. We don't have to worry about distribution and accumulation and, you know, climactic action and all of that sort of thing. Yeah, it's good to know and it's good to see, but look, you can see an awful lot just by doing this basic thing that I said I would kind of go do this a number of different ways tonight. And I really want you, if you don't come away with anything else but this, I'll be happy, I think. And I think you'll see a change in your trading, or hopefully it'll help improve your trading. Here we have, I put the rallies in green and the reactions in red. Here we have a rally up, good volume comes in, nice widespread, ease of movement to the upside. We react, look at this, volume reacts too. So what's it going to do? Of course it's going to rally, and we rally up. Rally's not that great. We get into the noon hour here. This is Eastern Standard Time, and the market tends to go flat. We often see counter trend trading occurred over the noon hour, but certainly we see volume dry up. Not always, but most noon hour days. I guess the guys and ladies who are trading go out for lunch. But notice, after 1:30, 2 o'clock, we should start to see something begin to happen in the S&Ps on the intraday basis. So they try to rally it up, and look at the volume. It's not in keeping with the rally that we saw earlier, or even the early part of this rally into the noon hour, is it? Interesting. Look at the reaction coming down. Wider spreads to the downside, increase in volume. Let's get and lower low now we have, right? Let's get a confirmation. Look at this confirmation coming up, no volume. There we go. The rest of the day sells off, and we come back down to close near the lows, or actually back down to the open of this day. So you don't need to have it real complicated. You can use the basics ideas of Wyckoff and step back and, what I say, have a soft focus. In other words, we tend to get so drilled in on the right edge of the chart, what's happening over here, and we forget all of this stuff that's going on. Well, start looking a little less to this side here on the right edge and look more in terms of the swings and what we call the waves, what Wyckoff called waves, but just the swings, and or rallies and reactions, and look for the volume coming in and going out here. Make sense to everybody? What about the idea that the market can rally on low volume? How do we start to differentiate between which move is real and which is weak on a low volume rally? Good question. Low volume typically happens at the bottom of a market where we have made some sort of a low and we've spent some time down there usually. And then as we start to rally up, the volume is fairly light. The market seems to float up, or as David used to say to me, it just levitates almost as if it's, going on its own. I don't ever see that except for when we're coming off the lows. So what to do in that situation is you want to spend time, Scott and others who are interested in this question, spend time assessing and building a story of either strength or weakness. Hopefully you're building a story of strength if you're looking to take a long position. And if you can build that story of strength like we did earlier on with the weakness, showing the climax and the preliminary supply and the breaking of the backbone and the anemic rally and the halfway point and the ease of movement to the downside. When you can start to piece together several elements in that story, and you're down at a bottom somewhere, you're on a low, I should say, and you see light volume, you can discount that a bit on the rally, okay? Yeah, so the background is first and foremost, always the background. And that's, what we're saying here. Okay, let's look at now the 2000 top here in the spring, and this is a weekly chart, and I'll drill it down into a daily chart. It's very good to look at old tops. Go back to as far back as data you can get and do this. It's really, really helpful. Same thing with bottoms, and you'll start to see these patterns just play right out. We get a little climactic action here up on A, high volume, wide spreads. And by the way, this was during the dot-com boom, and I remember every night the news was announcing another new market high. The NASDAQ was making a new market. I should have done this with the NAS, actually. This is SPY, I think. But every night, even on the public, the McNeil Lehrer News Hour, which is the public TV station here, they were announcing it. It was a top story every night. Taxi drivers were day trading between their fares, right? People were telling me that Microsoft was going to put their kids through college. Now, I don't know if any of you all remember that, but I sure remember that. And all of that was good warning that we were near a top. You didn't need Wyckoff for that. All you had to do was just look at the news and listen to the taxi drivers and the secretaries and stuff telling you about how Microsoft and Qualcomm were going to put their kids into school and make them millionaires. All right, so weakness comes in. Look at this big bar down. My goodness, this bar B. That's the biggest down bar on the largest volume that we see all the way in this uptrend. I look for those things, right? We see down bars. We see volumes start to increase, but we don't see big ones coming in. We're looking for that breaking of the backbone of the rally, as Wyckoff would say. And, just a way to assess it, certainly you can just eyeball it here. The spread or the range from high to low that we talked about earlier is pretty wide here and bigger than anything to the downside that preceded. But look at, we wipe out 1, 2, 3, 4, 5, 6. That's a month and a half of buying gets taken out in a week. That's pretty severe. And then we get about 6 months of rally in this big boom market. And look at the volume. I highlighted it here up to C. There's just no volume. Now here we go back more than the halfway point. So these things aren't locked in stone, but we're not able to make new highs after 6 months in a market that was on the news every night. All right, let's take a look at a daily chart. Here we see A, we see that acceleration in price. Look at that, straight up, just about, parabolic, unsustainable. That's climactic action. Volume didn't come in at the high here. It came in a little earlier, but climactic nevertheless. But the real story is at B and certainly at C, where we see the big volume coming in. This is the week, probably C is the week that we saw on the weekly chart. Yeah, coming in and wiping all of that out, right? And then we come across, and you can see that volume just is drying up as we go up here, especially at the end. So, you know, there was lots and lots of people buying stock at this point. I mean, everybody had stock. So it takes time for a market to you know, remove all of that demand, and that's really what you're seeing here. All right, so let's go a little further with this and just highlight here the clear look at the sideways action that we see. Significant weakness in the background. You can build that story, right? You got significant weakness in the background here. You know, we've been going sideways for 6 months. The rallies are just not producing the volume that they used to produce. They're anemic and they're weak, all right? And then if we look at the reactions coming down, we can see that volume is increasing to the downside. So we know supply, and now we've made lower low down here for the first time. So you want to look for a reaction back up to short on. Okay, so you build that story, and that's what we're talking about: the story of weakness and the story of supply. All right, back to the 1931 market here. Wyckoff talks about short covering rallies, and he makes the point that once the shorts have covered, there's no buying left. But we will see those sharp rallies in a long downtrend. And we do that here, right? We see that right at the edge of the chart here at B. We see this sharp rally coming up, and some volume comes in on this, right? We also have, and it's hard to see this here, and I'll show you a better example of shortening of the thrust, but something Wyckoff called shortening of the thrust, something I am very keenly aware of. And it's very helpful to know about when you're trading. It's basically kind of a rounding under of the bottoms here. In other words, there's just not a lot of progress to the downside being made as we're going down and making the new lows, yes, but those lows are not making a lot of progress down. Kind of hard to see here. We'll see a better example later on. But the rate of decline to the downside is diminishing here. Okay. But no, so the shortening of the thrust and this rally coming on moderate volume warn us of a potential turning point. Okay. But that rally that occurs from there up to C is pretty weak. Buyers are just not stepping in, and by now you should be able to see it immediately that the volume here, as we're trying to rally up to this high point here, just isn't there. We're just not getting the rally. When we do rally up here, we get a little pop in volume, but that's climactic. We come up to the high bar here and do a little up thrust. In other words, we rally up and then drop back down again and then fall off. And notice again, as we approach the low, increased volume says we're going to break that support. So we see this is short covering. We have a little bit of shortening of the thrust coming in here. Maybe that's why the short sellers wanted to cover. They could see that. Probably also because we're coming in, or we came into that support level from the beginning of this chart back in December, and some demand came in, everybody decides to cover it once for whatever reason, and so they do. Notice, though, that the very next bar here, and this is kind of important in a short covering rally, you'll often see this, the very next bar will still be on sustained volume, and it should follow through if it's going to have real rallying power. But we don't see that, right? So we will see that in markets. Here again is an intraday S&P chart, where we do see a little bit of buying come in here, a little bit of volume comes in, and the closes start to, you see a shortening of the thrust in the closes, if you will. The closes are not making much progress to the downside, and volume is coming in. So it tells us in advance that we're going to see a rally there. But look, the rally is, it's weak. We're not seeing lots of volume coming in. Same thing down here on B. We get more stopping volume, although there's good volume coming into the downside. We get a little pop here. We get a key reversal bar. The bar reverses and closes on its high. And on a 5-minute chart, we're likely to see a rally come in from there, and we do. Notice now, though, that we drop down here to C and look at the plummet here. We have now, if we were to draw a trend line or a trend channel off of here, we are now way oversold in the trend channel. It's a vertical drop. Big volume comes in, largest on the chart. This is climactic action here. We see a buying climax coming in here. Okay, big volume comes in, and we reverse and we rally up, and we see volume coming in on that reversal, and then come in and test this, and then go up. Let me just do this for you here. You can see, doing this, that we come down, good volume, the rally up, light volume, rally up, lighter volume, come down, good volume, rally, a decent rally, some volume coming in, bigger than the other two, but not still compared to here. We come down, big volume. Now we rally up, and look, we get good volume coming in as we dip back down into this area. We come down to this, and we reverse. And notice that becomes a point where we want to test down here at D, and as we do, volume is fairly light as we come down, and then as we rally up. Here we're getting that light volume rally and another absorption level here, going sideways and lifting right at the end. And then we rally up when we get high volume coming in. So again, looking at this a little bit more holistically, we can see the change of behavior that occurs. It gets tested, climax, test, and then we rally back up again. The biggest volume seems to be at the swing. I'm sorry, let's see. The biggest volume seems to be at the swings. Well, Len, at the end of a swing, we will often see a swelling of volume, and that will typically mark the end of the swing. If we're pretty much talking about downtrends here, as we see here, when we get close to the lows, the volume starts to swell. Same thing over here. We get much larger volume coming in, and that's typical. Something that Wyckoff wrote quite a bit about. Oh, Scott says the overnight session. It's okay to use the trend channel to detect oversold without the overnight session. I do. I mean, I'm aware of it, but I do. I don't. The volume is still in the U.S. session, the major amount of volume. So that's what I look at most. The absorption, yeah. Okay, I'll be happy to do that. If we erase this here, we know supply came in here. There was also supply in this big bar here with all that volume, and some supply that came in here. So as the market comes back up, well, a couple of things. Let's go into a little bit of detail with this. people seeing this kind of action would be thinking, my gosh, it's going to go to the moon. It's just going to rocket. And they get impulsive and they buy. So lots of premature buyers in here. Okay. Market comes down and then comes back into this area. And often what we see is what Wyckoff called absorption. In a known area of supply like this, or in a known area of resistance, we have a lot of longs that got long in here, followed this market all the way down, and then as it rallies back up, they're thanking their lucky stars that they can get out close to break even or break even. Okay? So that's what you're seeing here. The market's not, there's enough buying that won't allow the market to go down. It's just holding its gains and going sideways here. And absorbing whatever supply exists from the premature buyers who now are trying to get out at break even, or from the support and resistance sellers who are looking to short into the resistance. They're just absorbing that in here, and the way we can tell is fairly low volume, and it just goes sideways, and we'll often see, not always, but very frequently see the lifting of supports right near the end of it after it's gone on for a number of bars, and it's hugging right underneath that resistance level, and that's absorption. And Wyckoff talks about that quite a bit and I do too in the first section of that. Okay, so let's go back to, and let me know, Kay, if that's okay. If you need me to explain that more, I'll be happy to do that. But I think that's pretty thorough. So here was our short covering rally. Now, we fall a little bit lower, and look at what happens. Very similar to what we just saw. Now, this is different, isn't it? We see a little bit of what Wyckoff called bag holding here at C. Very large volume, narrow spread here, narrow range, shortening of the thrust to the downside, not much progress to the downside. It's as if people are selling, and you can see that, and I did a blow up of this because I wanted you to see this. It wasn't coming out on this larger chart. This is a blow up here of C. You can see that the market plummeted here, right? Not necessarily climactic action, a bit of climactic action, I guess you would say, but it scared people, and people would sell off and panic, and then it gets bought, and you can see that the buying is occurring on C because we're not going down on increased volume, even more volume than what we saw on the bar previous. That was widespread and really coming down good. And then, wham, we get a lot of buying coming in at D on sustained volume, not just moderate, but now we're coming in on higher volume. And the next bar on E is also showing buying, okay? Different than our short covering rally. Here we're seeing buying sustained over a couple of days. We see supply come in here, no question, but we see at least a couple of days. But immediately on our short covering rally, we start to see supply come in. And then we get that anemic rally back up. Here we get a little bit of an anemic rally as well, but we get an even more anemic reaction down. Volume is very light here. Also, notice that just like on the S&P chart where we had that reversal bar here, it sets up a support level. Buying came in here, and we come down and we get this narrow range bar in here. We've seen that before. The market goes dead here. It goes dull and dead up here, narrow range, and that causes the market to fall off because we have been going up. And down here it gets dull and narrow range, okay? But it's coming into a point where we had support here. It's testing this bar here. We didn't have lots of volume, but the price bar showed that it was bullish behavior. So we're testing this, and now we would expect this to rally on up again. Yeah, bag holding on B. No bag holding here. Bag holding here on C, Sam. This is bag holding, meaning that they're selling into it, but there's so many buyers there, so much buying going on, they're not allowed, it it doesn't allow the price bar to expand. If this were all selling, we would see, we would see the price bar expand. We'd have widespread coming down. But we don't. Instead, it's being contained. It's as if, and Wyckoff talked about it in terms of a postman. They would have the big leather bag or satchel, and it was as if they would open up the bag and say, put all your letters in. I'll take them. I'll carry them in my bag. So throw all your stock certificates in. I'll take them and carry them. Yep. Oh, that's okay. Your glasses were off. Yeah. No worries there, Sam. So we would expect a rally from this, and that's exactly what we get. We get that strong rally up, and we get a gap opening and a nice drive up. So this is a bit of a climactic action here, followed by a test. Very different than here, where we didn't hold the support levels. We instead come down on larger volume and break that support. Here we not only hold, it goes dull and narrow range, but now we gap up and rally from here. And Wyckoff said he would be buying in here on the open if he saw this, if he was watching it, or on the close, or wherever he could. But the heavy volume up that's this bar here, emphasizes the buying. The next day we go higher and on higher volume. That's positive. We come down and kind of wipe out the buying that occurred here, sort of, but look at the volume. It's really light. This is what we would call a test. VSA, Tom Williams, would call this a test bar. Another good spot to add to longs in here. And then the next day price goes higher. We do see some supply come in here, and we start to see dullness come in here. We see high volume, narrow range, more supply potentially in here, and we neck down into that apex. And in fact, this market does drop, tries to rally back up, and then continues to fall down. But we won't cover that today. But I wanted to do the complete sequence to the climactic action. So here we are in modern markets here with the S&Ps. This is a 120-minute chart, a chart I really like, a 2-hour chart. This was last January, and you can see that we have a trend channel coming down, and we get oversold down here at A. Look at the high volume. Look at the widespread. We don't see anything like that on the entire move down, right? Not with that kind of volume and that kind of range. So first time we see this, change of behavior occurs here. And now we want to see some testing action occur. And we see the market dips back down at B, closes on its low, so we don't know if it's going to continue the next day, but it doesn't. It pops up. We see buying come in at C, the high volume, good close. Buying again comes in at D, again at E, and again at F, or the bar before F. And, this is one of the clues to kind of knowing when a market might take off, is that as we see high volume here, it's coming in and continuing to test the high volume that we saw on this big up bar here on A. And the initial volume was pretty good. D kind of came in a little bit lower. E actually is this bar over here. On the test bar is over here, and then it rallies up from there. And then this is also a test, and it's on this volume. So volume is coming down as it comes to this level. So it's a clue that we're getting ready to leave this trading range. But you can see by the price bars and the volume and the reaction, it's easier to move up. Every time it comes down to this level, we're buying in here, and we know that because of the closes on the high. And so we would expect to see some kind of a rally, and we were down in here, and we rally up. And now, look, we're floating up on fairly light volume, decent volume. Every up bar is showing good volume coming in. But it's not as much as the last move down, but it's because we can put together the story. The oversold trend, oversold in the trend channel, the climactic buying that occurs, the numerous tests down and buying on those tests, the ease of movement up. So all of those things, we're not going to change that by a little bit of movement here. And in fact, this market, this was our area down here, and we rally up, we react a little bit, and we come all the way back up, and then this is right after this is the May flash crash, so-called flash crash down here. Yeah, the test closed higher, okay, and you can see volume came in a little bit, and the bars closed higher, and that's really, that it just says that buying came in. So I wanted to convey to you a little bit about the way in which I use Wyckoff. I'm looking for, these are the things I look for, and this is kind of a nice, it's in a way it's an outline of my own personal trading plan. I'm looking for stopping volume or climactic action, volume that stops the market. I'm always assessing supply and demand. You see that as I talk through charts. And also no supply and no demand, the tests that we see, the frequent testing that we see. I'm looking always for momentum or ease of movement or impulse. I mean, they're all the same, they're all synonymous. They all mean the same thing. It's just different ways of saying it. And then once I see that impulse or that ease of movement, I'm looking for confirming retracements, which we've talked about. Always looking for shortening of the thrust. Failure to follow through. We talked briefly about springs and upthrusts. I'll talk a little bit more about them in a minute. And then I like the relative strength and weakness, the comparative strength and weakness. Looking for that across the different indices or stocks or what have you. Looking at effort versus result. I'm drawing a lot of trend lines and trend channels. Didn't do that here, but it's important. And I don't look at Fibonacci or floor traders pivots or anything like that. I'm looking at the more obvious places. That's what works for me. Other people swear by Fibonacci, and that's cool. That's great. You look for this kind of stuff on those levels that we've been talking about. And always remember that every bar tells a story, and you want to consider its range, whether it's an up bar or a down bar, and the position of the close vis-a-vis the last couple of closes. That's important. But as important as that is, you really want to pay attention to market structure and try to build a story if you can. Okay? So those are some of the things that I look for. And always when I'm trading, what's always kind of singing in the back of my mind is this quote from Richard Wyckoff. It comes out of his first book called Studies in Tape Reading, which he wrote in 1910, or published in 1910. And he published it under the pen name of Rollo Tape. They were tape readers primarily back then. And so that was a cute, clever pen name. But his quote was this: "The study of responses is an almost unerring guide to the technical position of the market." The study of responses. That's what I'm always looking at, is how is the market responding? Another way to think about this, a more modern way maybe to think about this, is what Jim Dalton says, and I'm going to paraphrase him. He says, what's the market trying to do, and how is it trying to do it? How well or how good is it trying to do that? So that's kind of the same thing here. What's the market trying to do, and how successful is it in doing that? Study of responses. Okay, so, you can just look at this, and I'll go through this briefly here. We have a bit of a trading range that forms. And at O here was an open of the market, and it tries to rally up, and it immediately closes above the high of this level from yesterday. It immediately tells me that there's weakness coming in. And we see on bar 1, we come down, and we see that supply, that high volume comes in, that supply comes in. A little bit of bag holding on the next bar because of the narrow range, the mid-range close, and the high volume. It pushes the market up. But notice as we go up to 2, what happens to volume? It dries up. We try to rally back up above 2. We get a little pop in volume, but immediately it turns around, and it's a test of this. This is what we call an upthrust, a failure to follow through to the upside, and then this is a test of that upthrust. Okay, upthrust meaning that it's upthrusting this resistance point here. When we break through, we expect it to continue to go higher. When it fails to do that and comes back down underneath that resistance, it's what's known as an upthrust. And then it gets tested. And the test shows that there's no real buying power up here. And as it turns back down below there, below that resistance level, it's a nice place to short. And notice what we see here, increase in volume to the downside. It's easier coming down than it was going up in both this leg down and in this leg down. As we come down to 4, we see an increase in volume. What's going to happen to that support level? Odds favor that it will fail. We drop down, we try to rally back up. At 5, we have one of those little pushes to the upside, but on very light volume. It's just saying that there's no real demand there. The response to that is bar number 6, an increase in volume. We're going to continue to go down lower. We see a little buying come in here by virtue of the close. It rallies up, but look at the rally. The rally up to 7 is on weak volume, and the spreads are narrow. It's harder going up than it is coming down. We come into dullness, we narrow into that little apex, and then we come down from there. Bar 8 shows us that the support from our little buying moment over here with the increase in volume shows us that support level is likely to break, and we come down, we get a little climactic down here. Bar 11, we see good buying come in. First really good solid bar to the upside since this downtrend began with good volume, and we go sideways here. We don't even really test it, and we come back, we rally up on 12 here, and then we turn direction and we go up. But it's the same, yeah, high volume at lunch. Yeah, that's what I said. We don't always see low volume there. Sometimes over the lunch hour we will, I think it's because of the European session closing around 11:30 or so our time, and and I would assume that on a day like this, the DAX and the FTSE and those markets would be selling off as well, and our people would just, the U.S. market would just continue that sell-off, and that's why we're probably seeing this kind of movement here during the lunch hour. So you can see that this stuff, this is what I trade on the 5-minute S&P chart, so you can see that this is, it all comes out here. This is all Wyckoff. It really is alive and well. This is the last couple of days here we're looking at, last few days in the S&Ps. And I'm focusing mostly on the downside because that's what the second half of the Wyckoff case study is about, is the downside. So I wanted to show you mostly that. Same thing, we gap open here. This was the other day. We make a lower low below the low of this afternoon low from the day before. Some buying certainly is coming in. We see shortening of the thrust. See, it's hard to move this market down over 15 minutes. And the closes are coming in here, kind of clustering a little bit. And so we would expect a rally, and it does. But we come up to where, if we had extended on an average true range function, we would see a very large down bar here, right? We come back into that area where supply exists, and what do we get at A? We get big volume, poor close. We drop down, B shows more volume to the downside. We have a little rally up. We come back up into that area of supply over here. We go dull at the top here, a little pop in volume on the bar before on D. And then the next bar and the bar after that, E, shows us that was climactic to the upside. And then we start down again. We come into a 2-day low. Here's some shortening of the thrust. We have a lot of volume. Yes, it's falling off a little bit, but we're not making much progress down here. This is still pretty high volume here. at this point, and we can see that this was a 2-day low, and the day highs and lows are very important in the S&Ps, trading them intraday. Trading anything intraday, you're going to see importance there. But we rally off of that, and you can see buying coming in here. We rally up. We get kind of dull up in here. We get a little minor, little up thrust. I wouldn't even call it an up thrust. Just some weakness comes in. H shows us that supply is still prevalent. And mind you, we're coming into F where we saw a big supply. So we would expect sellers to come back in here. It comes back up. We come into dullness again at the top, very light volume, and it falls off. Now here it's a little different. We see big volume coming in, but we're not seeing acceleration coming down here. We're seeing, price bars are kind of average as they're coming down in terms of their range or their spread. And we're also coming into a multiple time frame support level. And on J, we see still a lot of supply. People are selling this market or selling out, selling short in here, thinking it's going to go lower, breaking down. But instead, it closes back up against the resistance. We try to come back down, and here we get some good spread, but look at the volume on K is not that great. And we come down, hold a little bit of a higher low, and close back up again. This is a spring, a failure to follow through to the downside. It's called a spring. It's a Wyckoff term. And it's a nice little trade when they set up like this, especially when you can coordinate it with something like a daily low, where 2 days ago, buyers came in. They're coming back in, and they're going to defend it in here as well. And then, so you have to keep that kind of stuff in mind as well, and then it rallies up from there. Again, background and context are really, really, really important. More important than, you can see we get big bars coming down, and how come that's not breaking down to new lows? Well, because we have a daily low there that we're leaning against. Okay? All right. Here's another way that I use this. I said I'd talk a little bit more about relative strength and weakness before we wrapped up, and let me just do that. Here's a 60-minute chart using multiple time frames, and I think it's really important to do this. Wyckoff didn't talk too much about this. He did in his tape reading course a little bit, but he didn't talk that much about it in general. And I think it's just a function of them not having computers and being able to, generate multiple charts easily. They did everything by hand, reading off of the ticker tape to construct some of his charts, like wave charts and such. The day before, we have a few days ago, we have some climactic action. We can see that it's coming down and it's oversold in the trend channel. We rally up. We get some good volume coming in. We tested it. But look at the rally up here. Very low volume. We really haven't come back down and tested down into this area to see if there's more supply. And there was quite a bit of supply over here. So you can look for a short opportunity to at least come back down and maybe come back into this gap area somewhere. Okay? All right. Now, here we have the S&Ps. I'm just going to represent this with SPY, the diamonds, the Dow 30, the Qs, the NASDAQ 100, and IWM, the Russell 2000. Well, you can see that the Russell and the NASDAQ both open and go higher. They gap down a little bit, right? But they rally up above yesterday's or this afternoon high here. And both the Dow and the S&Ps gap lower, but look at what happens. We see this an awful lot. So we pair the non-confirmation, the comparative weakness here in these markets, with a lackluster rally here, and we can say that, okay, there's a good chance that we're going to see this thing go down, and so we can look for a short opportunity, take a short in here somewhere. Okay, Is that clear to everybody how to use multiple time frames with Wyckoff and then the comparative strength and weakness here? What we should see, just to be clear, what we should see is we should see if this was going to rally, we should see all of these markets making rallying up to new highs here, maybe coming back and testing yesterday's high and then shooting up from there. But we don't see that. We see failure to make it all the way up, okay? And that's important. That's a really nice clue. All right, so that's kind of how I use Wyckoff on a day-to-day basis. Let me just give you, I said I would give you a trade setup, and this is probably the best downside trade setup in terms of results and in terms of good odds that I can think of. And it's called falling through the ice, but you don't even need to know the name of that. It's just a simple idea here. We have an extended trading range here. We have a long sideways line, okay? Price breaks down through that. We don't even need to assess whether this is supply or demand in here, if you don't want to, just to make it even simple. But we see a breakdown with momentum. Okay, if you're using an oscillator, an unbounded oscillator like a MACD or a moving average oscillator, you'll see this oscillation get larger than anything that you've seen so far in the past, okay, especially from this trading range. But we will see volume come in, and we do see volume come in as it breaks down, and we see a good movement down. That's momentum or impulse or ease of movement, okay. Then we get a weak rally, and that rally comes up, back up underneath the trading range, maybe a little bit into it, but not too much, okay? Comes back up to the bottom of the trading range, into this zone, and then it starts to show us some weakness. Maybe we see a little climactic action, and then, you know, on a minor climax basis, we've talked a lot about that tonight, and then it rolls over, or maybe it just goes dull and then starts to come down, whatever. But we see that weakness, and we look for a short there. There's different ways to do it. You can just put a limit order in at this point. Probably not the best thing to do, but fairly safe in this instance, in this kind of a setup. You can wait for a reversal bar like this. You could draw a trend line in here, and as it breaks the trend line, you could take it. You know, there's a lot of different ways to do that. Here's another example on a same market, actually. This is the pound. These work best when we have weak conditions. So we're coming down here, we go sideways, there's not much of an ability to rally up here. It tries to rally and it fails, and it comes down, breaks down through the downside of this. We have a weak rally, and then we have an opportunity to go short as it comes back up to the bottom of this trading range. You can stop yourself in on a break of the trend line. You could go to a lower time frame and look for some kind of a weak bar pattern in there, whatever you use to go short. Here's an example. I don't want you to think that this is so Pollyannish that everything is going to work out well. Here's an example where it doesn't work out so well. And you would think that it would just tank from here. Here we get a little up thrust. We talked a little bit about that before. We have some resistance. It tries to rally up above. No follow through up there. It comes back down. Not a bad spot to take a trade in and of itself. We see good spreads coming down, increased volume. We expect this trend, the support line to break. It does, and it breaks pretty nicely from what I can see. We come back up, and you could take a short in here, would be one spot, or maybe a short in here, or even, well, this is probably too far up. It's halfway into the trading range. I wouldn't take a short in here. But certainly the first two locations, I'll just number them 1 and 2, would be okay. Would be, I would think that they'd be good spots. This is a forgiving trade, meaning that you're leaning against resistance here. This had been support. It should now become resistance. You're leaning against that, and the odds are good that it's not going to break through it too much. And so you will get a little bit coming down. When you start to see this, if you shorted in here and you start to see this kind of action where it doesn't go anywhere, or this kind of action where it doesn't go anywhere, then you want to get out. So it is kind of forgiving, but I did want to show you that it doesn't always work all the time. But it does work much of the time. And here again we have an up thrust, just clear indication that we're going to break through. We do. Now here we don't get incredible momentum after the breakdown, but we've gone a long way from this point to here, and we see weakness come in as it tries to rally back up. You can see that there's no volume coming in. It's a weak rally. We get a nice, something we call a hidden up thrust, which is just basically a minor up thrust. If we were to go into a smaller time frame, we would see the same kind of thing here, because we see a high and then it drops down to a low and then it comes back up and up thrust that high. So if we drop down to a very small time frame, we would see it that way. So that's why it's called a hidden up thrust. And then we get, as we break down the support, we get more volume coming in. We even get a mini one right here, right? It comes back up to the support level, which is now resistance, and then it falls off from there. So it's, a simple but classic, very high odds trade, and forgiving when it doesn't work, for the most part. And here's the criteria for it. We see a good, solid, long sideways line or trading range. The longer, the better. Price falls through the downside with momentum. I showed you a couple of variations on that as well. We get that weak rally back up to the underside of the trading range. And clearly, it works best with weakness in the background. So construct your story of weakness. And then when it does break down, you don't have to sell. You don't have to sell the high tick here. Well, this is not the best example, is it? You don't have to sell the high tick up here. Yeah, it'd be nice to do it, but look, if you got in here, you still have a pretty good run down, no question about that. This is a very nice trade that you can see happening, and you can take with confidence. If you go through your charts and go through your markets and look for this, you'll see it happen, not all the time, but good enough frequency. It's a very good trade. I'm going to leave you with a few quotes. I won't go through them because the hour is getting late, but a few quotes that you have on your slides from Wyckoff primarily, but also there's one in there from Bob Evans and Tom Williams. I'll talk briefly about who they are in a moment, but you can look at those. I think they're helpful. Some resources for, Kay says, let's go back up. You've got a question. I'm sorry, Kay. I'm kind of pushing through here and not thinking. Okay. Why not take the trade in the middle of the trading range? Good question. And I think you're referring to this in here. Well, once it comes up to the middle of the trading range, I don't know really what it's going to do. To me, it's telling me that it may come back down, hold in here, and then rally back up. It didn't do that in this instance. I like to play on the edge of a trading range, either on the bottom of the trading range or on the top. I'll short it up here, or I'll short it down here, or I'll go long down in here, possibly. I'm not saying that this would be a trade I would take, but I would be looking to go long as it comes into support. I like to lean against that. Here, I've got no support, no resistance. I'm in the middle of nowhere. It's like no man's land, and I don't want to be caught there. The odds are low that I'm going to get a good trade out of it, and the odds increase much, much greater if I'm on the edge of a trading range. And that's the main reason for it. That's just part of my trading plan, one of my rule sets. Okay, some resources. Certainly check out my blog. I've got some free stuff there that you're more than welcome to avail yourselves of. We've got some paid things as well. I've got several articles, including some on Wyckoff principles on moneyshow.com, and they did some interviews of me. It was kind of fun to do on the trading psychology side of things. For those of you who may not know, I'm also a psychologist. Think about that combination, psychologist and a trader. And I've got a few articles and also webinars, free webinars that you can view, and some are on Wyckoff at SFO, Stock Futures and Options magazine. So those resources are available to you. And I also wanted to give you what I think are some of the best stuff in the Wyckoff literature. Certainly down here on the bottom, the Wyckoff course in stock market science and technique, and also in a course in tape reading and active trading. It's the first day trading course that I know of. And Wyckoff wrote it and published it in 1932. He published it after the main course. So he always said that the main course you need to know first, and then you can look at the tape reading course. Both are excellent. Both are still available from the Wyckoff Stock Market Institute out in Phoenix, Arizona. After Wyckoff died, he set up the Wyckoff, it was called Wyckoff Associates, now it's called Wyckoff Stock Market Institute. He set that up as an educational organization for the public. And it was owned for a long time by Bob Evans, Robert G. Evans. And Evans used to make a wonderful series of lecture tapes each week that they actually would send around to be, in the early part, in the late 1940s, they'd actually send the tape machine around. They bought a few of them, I guess, and they had just a handful of people, and they would actually send the machine out. But then it just got to be tapes, and now they have them. I think Craig and Gary have them as Craig Schroeder and Gary Schuber, who own Wyckoff SMI. They have them as downloads on their site. And some of that stuff is really, really good. George King, a little bit later in the 1960s, did a series called Back to the Books on Wyckoff. Just outstanding stuff. Dave Matthews, another one of my Wyckoff heroes, did some wonderful things on anticipating market moves. Again, those lecture tapes, those were in the 1970s. So you've got several decades worth of material there. I mentioned Rollo Tape, Wyckoff's earliest work that he published called Studies in Tape Reading. That's really good. David Weiss, I would encourage you, if you're at all interested in this, in an inexpensive book that Jack Hudson was the editor. It's called Charting the Stock Market, the Wyckoff Method. I think you can get it for 10 or 15 bucks. He did a wonderful couple of chapters on trading the bond market. And he was who I learned this stuff from, so he comes highly recommended. And then Tom Williams wrote a book called The Undeclared Secrets That Drive the Stock Market. Tom Williams, of course, is the guy who kind of computerized this and into this thing called volume spread analysis. But it's basic Wyckoff. But his book is really good as well. It's a very lucid description of many of the Wyckoff principles. So you got plenty of resources there to avail yourself of and study and keep learning this.